practical economic knowledge. 1. Introduction. Economics as a social science explores how humans allocate scarce resources to meet unlimited wants. In modern society, economic knowledge is not just confined to academic disciplines, it's a practical tool that everyone should grasp. This article aims to share fundamental economic knowledge to help readers better understand and address economic issues in their daily lives. With the continual evolution and development of the global economy, concepts such as inflation, interest rates, and investment returns have become focal points of concern. The rise in inflation rates can lead to a decrease in the value of money, consequently affecting people's living standards. Meanwhile, fluctuations in interest rates directly impact the cost and returns of loans, savings, and investments. Investment returns serve as crucial indicators for investors to evaluate investment value, directly affecting the financial positions of individuals and institutions. Furthermore, economic policies and decisions wield significant influence over the overall economic operations of society. Government monetary and fiscal policies can adjust economic growth and inflation levels by altering interest rates, taxes, and government spending, subsequently affecting employment and income distribution. Thus, understanding these basic economic principles not only aids individuals in comprehending economic phenomena in daily life, but also assists businesses in making wiser investment decisions and governments in formulating more effective economic policies. In this era of information explosion, mastering fundamental economic knowledge has become essential for enhancing personal competitiveness, adapting to societal changes, and actively engaging in discussions on social and political issues to collectively promote the healthy development of the socio-economic landscape. Therefore, through the practical economic knowledge shared in this article, we can better confront economic challenges in daily life, engage in more rational personal and organizational financial management, and actively participate in discussions on social and political issues to foster the healthy development of the economy. 2. Inflation and inflation rate. Inflation refers to the general increase in the price level of goods and services over a period of time, resulting in a decrease in the purchasing power of money. It is often associated with factors such as excessive demand expansion, rising costs, or an increase in the money supply. Inflation has various impacts on the economy and society, making it crucial to understand the concepts of inflation and the inflation rate. The inflation rate is an indicator used to measure the extent of inflation, usually expressed as a percentage. The calculation of the inflation rate is based on the change in the price level within a specific period. Generally, when the inflation rate is positive, it indicates an increase in the price level, while a negative inflation rate signifies a decrease, also known as deflation. Determining the inflation rate involves multiple factors, including consumer spending, production costs, and monetary inflation. Inflation affects both consumers and businesses. For consumers, inflation reduces their purchasing power, leading to a decrease in the quantity of goods and services they can buy with the same amount of money, thus raising the cost of living. For businesses, inflation may result in increased costs, including raw materials, labor, and transportation costs, thereby impacting their profitability and competitiveness. Effectively managing inflation and the inflation rate is a critical issue in economic management. Central banks and governments typically formulate corresponding monetary and fiscal policies to control the level of inflation. By adjusting interest rates, the money supply, taxes, and government spending, they influence the operation of the economic system to maintain price stability and economic growth. In conclusion, inflation and the inflation rate are essential concepts in economics, with significant implications for individuals, businesses, and governments. Understanding these concepts can help people better cope with the challenges posed by inflation and enable the effective formulation of economic policies and personal financial plans. 3. Interest rates. Interest rates refer to the cost of borrowing funds or the return earned when lending money, and they also represent the time value of money. The level of interest rates directly affects the cost and return of borrowing, saving, and investing, thereby exerting significant influence on the financial conditions of individuals and businesses, as well as economic activities. Interest rates are determined by market supply and demand and are typically influenced by central banks through monetary policy. When central banks raise interest rates, the cost of borrowing increases, prompting individuals to reduce borrowing and increase savings, thus restraining consumption and investment. Conversely, lowering interest rates stimulates borrowing and investment, promoting economic growth. Interest rates have a direct impact on individuals and businesses. For individuals, high interest rates imply increased borrowing costs, which may reduce their consumption and investment and increase their financial burden. For businesses, high interest rates may increase their financing costs, affecting production and expansion plans, and consequently impacting profitability and competitiveness. Interest rates are also a crucial indicator for investors to assess investment value. The return on investment needs to exceed the interest rate to be considered profitable, because investors have the opportunity to leverage low-cost borrowing for investment. Therefore, changes in interest rates directly affect the attractiveness and risk of investment. In summary, interest rates are an important regulatory tool in the economic system with profound effects on financial markets and the real economy. Understanding the trends and influencing factors of interest rates helps individuals and institutions better formulate financial plans and investment strategies to adapt to the constantly changing economic environment. 4. Investment returns. Investment returns refer to the profits generated from investments and serve as a crucial indicator for evaluating investment performance. Investment returns are typically expressed as a percentage or specific monetary amount, taking into account the costs and duration of the investment. Understanding the concept of investment returns is essential for individuals and institutions to formulate investment strategies and financial plans. Calculating investment returns involves two main aspects: investment income, which includes the revenue or appreciation generated from investments, and investment costs, encompassing the expenses and risks associated with the investment. The level of investment returns can vary depending on factors such as the type of investment duration, market performance, economic environment, and policy changes. Generally, higher investment risks are associated with higher expected returns. Investors need to strike a balance between risk and return to ensure long-term stable growth of their investment portfolios. There are various methods for calculating investment returns, including simple return rates, compound return rates, and internal rate of return, IRR. Different calculation methods provide different perspectives for evaluating the effectiveness and value of investments. Additionally, investors should consider factors such as inflation rates and tax implications to more accurately assess the actual value of investments. In conclusion, investment returns are indispensable indicators in investment evaluation and financial management. By deeply understanding the concept and calculation methods of investment returns, investors can better formulate investment strategies, select investment projects that align with their risk tolerance and investment goals, and ultimately achieve long-term financial growth. 5. Economic policies and decisions. Economic policies are measures formulated and implemented by governments to influence the operation of the entire economic system. Through economic policies, governments attempt to regulate factors such as economic growth, inflation rate, unemployment rate, and monetary stability to achieve economic stability and growth. Economic policies are generally divided into two main categories: monetary policy and fiscal policy. Monetary policy is primarily formulated and implemented by central banks, which adjust interest rates and the money supply to influence economic operations. Typically, when the economy is in recession or experiencing rapid inflation, central banks may lower interest rates to stimulate economic activity or raise interest rates to curb inflation. Fiscal policy, on the other hand, is the responsibility of the government, involving adjustments to taxation and government spending to influence economic activity and resource allocation. The formulation and implementation of economic policies require consideration of multiple factors, including economic cycles, domestic and international economic environments, and political factors. Governments need to formulate appropriate policy measures by monitoring economic indicators and conducting risk assessments to respond to the constantly changing economic situation. The selection and implementation of economic policies have significant implications for economic development and social stability. Proper economic policies can promote economic growth, improve living standards, and reduce unemployment rates, while inappropriate policies may lead to issues such as inflation, unemployment, and economic recession. In conclusion, economic policies and decisions are crucial factors affecting the operation of the entire economic system. Through appropriate policy formulation and implementation, governments can effectively address economic challenges, promote economic stability, and sustainable growth, benefiting society as a whole. 6. Conclusion. Economic knowledge significantly impacts our daily lives and work. By understanding basic concepts such as inflation, interest rates, and investment returns, we can better navigate economic challenges and make informed decisions. Inflation and interest rates are pivotal indicators in economic operations, directly influencing our consumption, savings, and investments. Understanding the trends and influencing factors of these indicators helps us mitigate the impacts of inflation and currency depreciation, as well as comprehend the effects of interest rates on borrowing and investment costs. Investment returns serve as crucial benchmarks for assessing investment value and achieving financial goals. Through a deeper understanding of the calculation methods and influencing factors of investment returns, we can formulate more effective investment strategies to realize financial growth. Furthermore, economic policies and decisions are vital for the operation of the entire economic system. Monetary and fiscal policies formulated by governments directly affect economic growth, employment, and currency stability. Understanding the operation and impacts of economic policies helps us better adapt to economic changes and promote robust economic development. In conclusion, mastering practical economic knowledge is key to adapting and succeeding in modern society. Through continuous learning and application of this knowledge, we can better comprehend the principles of economic operations, enhance personal and organizational financial management capabilities, and actively engage in social and political affairs to collectively foster healthy economic development.